as Charlie says, we are doing projections in our head, obviously, when we look at a business. I mean, when we look at any company to buy or any stock to buy, we are thinking in our mind. We've got a model in our mind.
Hey guys, in this clip from the 2011 Berkshire Hathaway annual meeting, Warren Buffett and Charlie Munger are asked a question on projections and growth. What I've done is I've taken all the great pieces from this Q&A section, edited them down, and then what I'm going to do at the end is highlight some of the things that they talk about in Excel to really put a finer point on it. So thanks for watching. I'll see you at the end. Please subscribe, like this video, share it widely. I'd really appreciate your help in growing this channel.
When we look at a business and we're looking out in the future, obviously if we see growth in that picture and it's growth produces a high return on incremental capital involved, we love it. But we do not rule out companies where we think there'll be little or no growth if the price is attractive relative to the earning power. It's a factor in every investment decision because we're really looking out to the future as to future earning power, but also future capital requirements. And we think plenty about whether any business we go into is likely to grow profitably. And sometimes we're right and sometimes we're wrong. But we don't rule out companies that have very slow growth or no growth possibilities. Charlie?
Yeah, an enormous false precision gets into things when you program computers to make forward projections for a long period of time. We make rough projections in our head all the time.
Sure.
And we don't do any of those formal projections because the fact that they're there in paper and came out of a computer makes some people think they must be significant. I really think they do more damage than they do good.
But we do, as Charlie says, we are doing projections in our head, obviously, when we look at a business. I mean, when we look at any company to buy or any stock to buy, we are thinking in our mind. We've got a model in our mind of what that place is likely to look like over some period of years. And then we also have some model in our mind of how far off we can be. I mean, there's some things we can be way off on. There's other things we're likely to be in a fairly narrow range on. So all that is taking place. But we sure don't want to listen to anybody else's projections.
Those of you who are about to enter business school or who are there, I recommend you learn to do it our way, but at least until you're out of school, you have to pretend to do it their way.
All right, guys, so what I have on my screen here is a basic discounted cash flow model. And while I don't use these to value businesses in practice, I do understand them. I've built them, and I just wanted to show you in Excel kind of what Warren and Charlie were talking about here. So the biggest takeaway for me that I've learned over the years is really return on invested capital is really the thing to look at. Growth can happen at low rates of return on invested capital and destroy value, or if they happen at good rates of return, they can add a lot of value. And so we're going to show that here on the screen. So, but the thing to remember is that growth doesn't always equate to additional value. So I've just laid out this basic discounted cash flow here in Excel. And when I built these, for school or, at various times, what I always like to do is build in a check. So what I'm starting here is with $100 of capital, a 10% return, and a 10% discount rate. Now, what I've done is I've said, let's project this out to infinity and see what the present value is. So at a 10% return, discounted at 10%, the value should equal what the present value is. So all this is showing here is that we're starting with $100 of capital. The earnings are going to stay flat forever. And what that does is you can see that the present value of these first 10 years are equal to the 61.45. And then the terminal value, everything from year 11 all the way out, is equal to 38.55 because it's year 11 all the way out to infinity, but then discounted back 10 years. So you get this 38.55. So no surprise when you build your models, the present value of 100 should equal this capital here, which is in theory, if you're doing a net present value type of analysis, that's the capital that you would have outlaid in year zero. But we're going to depart from here, but I just wanted to show you this. So we have this business. It's distributing all of its earnings forever, and it's earning 10%, and it's we're discounting it at 10%. Now, what's going to happen if we let this business grow for 10 years and then distribute all the cash? So let's take a look at that. So we're going to leave our return at 10%. Now we're going to take our retained percentage. So we're going to change that to 100. And what's that's going to do is it's going to retain all of the earnings. Look what happens. The sum of the present value of years 1 to 10 goes to 0, right? Because we're not distributing any cash from this business. We're just letting it grow. That puts all of the value into the terminal value. And why is that? So what we've done is that the capital is going to retain and grow and compound year by year. So by year 10, we're going to have almost $260 worth of capital in this business. Now, coincidentally, or not coincidentally, actually, the earnings will have grown by the same rate, because this business can only earn its return on invested capital. So capital goes up, and its earnings can only grow while its capital grows. But what this does is the growth has come from retaining these earnings. And so you have this perpetual cash flow now of $26, call it, from year 11 to infinity. But that is only worth, on a present value basis here in year 0, $100. So we've created no value by retaining this capital. And that's a very important point. I see a lot of investors just look at what the earnings have done. And if you just look at that right here, you'd say, wow, this business is growing at 10% a year. And you're not wrong in that, but the capital is also growing. And that's a very, very important point. And what this also tells us is, so we're just gonna change this back to 0 here for a second. What Buffett said was, don't rule out no growth businesses if the price is attractive. So if we were to find a business that had no reinvestment capabilities, and it could only pay us this $10 forever, we could reasonably calculate that this business was worth $100. Now, if we could buy this business at $90 or $80 or $70 and give ourselves a margin of safety, we could earn that 10% over time, and that would be attractive. If this business earned 15% on capital, and we still use this 10% discount rate, and we said that stream of cash flow, that $15 going out to year 10, and then, going out to infinity, that is worth $150. But again, that's really just tied to the return on invested capital. It's nothing to do with retained earnings. Now, if we have this business that can earn 15% return on capital, and we retain 100% of earnings for the first 10 years, look what that does to the present value. It brings it way up. And that the reason for that is that you're compounding at an incremental rate of return for 10 years, and then just assuming a 10%. We're just assuming 10% after that. So 10 years of 15% growth is going to increase that present value quite significantly, because what you're doing in effect is the compounding is going ahead at 15% and the discount is bringing it back 10. So you have a present value compounding at 5% per annum for 10 years. So all of that is accruing to you on a present value basis. Now, in this example, we still have 0 present value of cash flows in years 1 to 10 because all of it's in the terminal value. But what we've done is we've increased that terminal value. So when you bring it back to the beginning in year 0, it's worth more. Now, any business might have a different payout ratio. In this case, let's change it to 50%. You can see that it lowers the present value because we're taking that cash and saying, okay, we're going to take it at 10%. We're okay with that, and we're going to let the remainder of it grow. So again, profitable growth. Buffett talked about profitable growth, and profitable growth means incremental capital retained at rates of return higher than your discount rate. Because if you're retaining capital equal to your discount rate, you're not adding any value. Don't use a computer. I've come to do this or not do this, not use a computer. What I've found is and it's just my bias. I want cash today. So in this case, if I found a business that was earning 15% and it could pay 50% of its earnings out, I want more of it into this year 1 and 10 here. If the business can retain 25% and pay out 75%, more of that gets into the present value, and that certainty is worth a lot. And I think Buffett thinks the same way. And how far off could we be? So when you're looking at this and you say, geez, there's 10 years here and then there's the future, two things here. So it shows you how difficult it is. I mean, we don't know. You have to think when you're thinking about a business in year 6, 7, 8, 10. What could happen if we're earning these great returns on capital? Could competitors come in and lower that return on capital by driving down margins, or increasing the capital requirements of this business in some way? There's a lot of uncertainty that can happen out here in year 10. A lot of times analysts will use either too low of a discount rate and or a lot of a too high of a growth rate, and that increases the terminal value, which again, I've just used 10%, which basically means no future present value growth from year 11. But if you're using too high of a growth rate, that can skew the terminal value very high. And what I probably should have done here is done this as a percentage of the total. And then that way you could see how much came from each. So if you have too much of your, if we're going to retain, if we're going to retain 100%, all of your value becomes in year 10. And that's riskier than if this business paid out 0. Now, the trade-off that you have to make here is if I'm retaining 100%, and this, in theory, this present value is 234 versus retaining 0 and paying out everything at 150, is that incremental potential future value worth the risk versus taking that cash today? So I hope this fairly simple model, and if anybody's interested, please let me know and I'll send this to you, illustrates that growth is not just something that sort of happens. It comes from something. You really have to think about both the return on invested capital and the reinvestment requirements that the business has. And both of those can change over time. But growth is not something, most businesses have some sort of relationship between the capital that they employ and the earnings that they generate. And many businesses require additional capital. And if it's not explicit capital that's on the balance sheet, it might be additional expense that lowers earnings. And I'm thinking about companies that invest in R&D, for example. But there's some sort of relationship between to get those higher earnings in the future, you're going to need additional capital employed in some manner. So We're on 12 minutes here. This is getting to be a long video, but if you liked it, if you have any questions, please let me know. If I made any mistakes, which I'm certainly liable to do, please let me know. Look forward to the discussion. Thanks again for watching. If you've watched this far, really appreciate you watching and helping me grow this channel and learning together. And that's what it's all about. So thanks again. Hope everybody has a great day and stay rational.